Hi, this is Steve Ray with today's Lone Star Lending Starbits rate update. Trade uncertainty last week set off a feeding frenzy in the bond market. Investors gobbled up Treasury bonds in a flight to safety buying spree that saw the 10-year rate drop by 40 basis points in just over a week. The 10-year rate is now the lowest it's been since 2016. Given that we always talk about mortgage rates tracking the 10-year Treasury, shouldn't mortgage rates be looking superb right about now? Well, not exactly. While mortgage rates tend to move in the same direction as the 10-year T-bill, there's one big reason that mortgage rates lag behind when it comes to rapid rate changes. When an investor buys a 10-year Treasury bond with a 2% rate, the investor knows that bond will pay 2% interest for exactly 10 years, period. When an investor buys a 30-year mortgage security with a 3% rate, the investor knows it will pay 3% for 30 years, if and only if the borrower doesn't sell, refinance, die. Of these, refinancing is the greatest risk when rates are moving lower. Let's say an investor buys a mortgage security with a loan balance of $1 million paying 3%. The investor expects to receive payments equal to the loan balance plus the interest paid on the loan, so the investor pays $1.04 million for the security, a premium to account for the interest. Now let's say rates keep dropping and the borrower refinances after 12 months. The borrower was paid roughly $30,000 in interest, but the investor paid a $40,000 premium. Not a winning investment strategy. Investors still want to purchase mortgage securities, so what do? They reduce the premium they'll pay. The way this shows up for borrowers is in the interest rate. In the example above, it takes $40,000 of premium to make everyone whole in the mortgage transaction. If the investor only offers $30,000, the lender needs to make up the extra $10,000, and it does that by offering the investor, and thus the borrower, a slightly higher interest rate, thus inducing the investor to pay the required premium. Now, the borrower will see a lower rate than before rates fell because the cost of money is lower, but the borrower's rate won't fall as quickly as that of more predictable bonds, such as treasuries. If treasury rates settle into the current range for a while, the refinancing risk will abate, and mortgage rates eventually will catch up. That's Starbits for today. Please comment below and follow us daily on our Texas Lone Star Lending website.